types of investments, where your money can grow. Welcome back. Now that you understand what investing is and how money grows through compounding, it's time to explore the fun part, where you can actually invest your money. There are many different types of investments out there, and each has its own personality, its own risk level, reward potential, and purpose. Let's break them down one by one, so you can understand how they fit into your journey. Why? Stocks. Owning a piece of a company. Let's start with one of the most popular and proven forms of investing, stocks. When you buy a stock, you're buying a small piece of ownership in a company. That means that the company grows and makes more money. Your piece becomes more valuable too. Stocks are like owning a slice of Apple, Tesla, or Amazon. When those companies innovate and succeed, you share in their profits. Over time, stocks have historically given some of the highest returns, around 7% to 10% per year on average, if you stay invested long term. But here's the catch. Stocks are volatile. Their prices move daily, sometimes dramatically. That's normal. It's just the market reacting to news, earnings reports, or investor emotions. If you zoom out and hold stocks for years or decades, those bumps smooth out, and the overall trend tends to be upward. There are two main ways to earn from stocks. Capital gains, when the price goes up. Dividends, when companies share part of their profits with investors. Stocks are great for long-term goals like retirement or wealth growth, but not for short-term needs, because prices can swing a lot. Bonds. Lending instead of owning. Next, let's talk about bonds, one of the safest and most stable investment types. When you buy a bond, you're not buying ownership. You're lending money to a company or a government. In return, they promise to pay you interest over time and then give back your original money at the end of the term. Think of it like this. Stocks make you a partner, bonds make you a lender. Bonds are considered lower risk, but they also have lower returns, usually 3% to 5% per year. They don't grow explosively, but they provide steady income and stability to balance riskier investments like stocks or crypto. Many investors use bonds to protect their portfolios during market downturns. When stocks go down, bonds often hold steady or even rise. That's why a balanced portfolio might be something like 60% stocks, 40% bonds, growth and stability together. Real estate, building wealth you can see. Now, let's move to something you can touch. Real estate. Real estate investing means owning property, homes, apartments, offices, or land that you can rent out or sell for profit. It's powerful because it gives you two forms of return. Rental income, regular cash flow from tenants. Appreciation, when the property's value goes up over time. Real estate also offers leverage. You can use other people's money, like a mortgage, to control a large asset with a smaller upfront investment. But it's not all easy money. Real estate requires maintenance, management, and sometimes large amount of capital. If you want exposure to real estate without owning property directly, you can invest through REITs, real estate investment trusts, which let you buy shares in large real estate portfolios. Just like stocks, real estate adds diversity and protection against inflation, since property values and rents often rise with the cost of living. Crypto and digital assets, the new frontier. Now, for one of the most talked about investment types today, cryptocurrency. Crypto is digital money that operates on blockchain technology. It's decentralized, meaning no single government or bank controls it. The biggest names you probably heard are Bitcoin, Ethereum, and Solana, but there are thousands of different crypto projects out there. Crypto offers incredible potential for growth. Some coins have increased thousands %, But it also comes with extreme volatility. Prices can drop 30% in a single week. So should beginners invest in crypto? The answer, yes, but carefully. Treat it like a small, experimental part of your portfolio, maybe 5% to 10%. If you believe in the technology, the long-term rewards can be massive, but always use trusted exchanges, store your crypto securely, and never invest money you can't afford to lose. Crypto has also given birth to DeFi, decentralized finance, where you can lend, borrow, and earn interest without traditional banks, and NFTs, digital ownership tokens for art, collectibles, and more. These are exciting new frontiers, but remember, innovation always comes with uncertainty. Move smart, do your research, and think long-term. Mutual funds and ETFs, easy diversification. If picking individual stocks or crypto feels overwhelming, there's an easier way: funds. A mutual fund or ETF, exchange-traded fund, is like a basket that holds dozens or even hundreds of different investments. When you buy one share of a fund, you're investing in all the companies or assets inside that basket. That's instant diversification. Your risk spreads out automatically. ETFs are especially popular because they trade like stocks, are low cost, and are great for beginners. For example, an ETF that tracks the S&P 500 gives you exposure to 500 of the biggest U.S. companies in one simple purchase. You can also find ETFs for crypto, bonds, or real estate. They're one of the easiest ways to build a balanced, hands-off portfolio. Other investments, gold, commodities, and index funds. Beyond the big categories, there are other investments worth knowing. Gold and precious metals are traditional safe havens. They protect against inflation and economic uncertainty. Commodities like oil, silver, and agricultural goods are useful for diversification, but can be volatile. Index funds are a type of mutual fund or ETF that simply tracks a market index like the S&P 500. They're low cost, reliable, and one of Warren Buffett's top recommendations for everyday investors. Choosing what's right for you. Now that you know the types of investments, the real question is, which ones are right for you? It depends on three things. Your goals. Are you investing for retirement, buying a house, or building wealth? Your time horizon. How long can you keep the money invested? Your risk tolerance. How comfortable are you with market ups and downs? If you're young with decades ahead, you can afford more risk and focus on growth, like stocks or crypto. If you're closer to retirement, you might shift toward bonds or dividend-paying stocks for steady income. And remember, diversification is key. Never put all your eggs in one basket. A simple starter mix could look like 60% stocks or ETFs, 30% bonds or REITs, 10% crypto or alternative assets. Adjust over time as your goals and confidence grow. That wraps up part 3. You now understand the major types of investments and how each one plays a unique role in building wealth. In part 4, we'll explore how to actually start investing, setting goals, choosing platforms, and building your first portfolio step by step.